Welcome to the Techno Fundamental Report for October the 19th. In difficult markets, I always find it very helpful to read books on the subject. I know it's not what everybody wants to do, but I think you should. And one of the books that I always have enjoyed is How to Make Money in Stocks by William O'Neill. I first started learning about William O'Neill back in the early 1980s. He did a 100-year study of the stock market. Basically, the purpose of the study was to determine what were the very best performing stocks during the period that they studied, which was 100 years. The most interesting thing I took from the book was, and you might want to pause your video player and read this, but it talks about how PE ratios can be so misleading. A low PE ratio does not necessarily mean that it's a good deal. I'll give you an example. Back in the early 80s, I was approached by a friend and he said, you need to take a look at Walmart. Well, I took a look at it and the PE ratio was too high, so I didn't buy the stock, and as a result, I missed out on a tremendous opportunity. Book number 2, How I Made $2 Million in the Stock Market by Nicholas Darvis. You know, Darvis was a professional dancer, and he traveled around the world doing these dance routines back in the 40s and the 50s. And he was able to start with basically nothing, money-wise, and built it up to $2 million in 1956. So $2 million in 1956 was a lot of money. I know it doesn't sound like much now, but it certainly was back then. So you might want to, again, take a look at his key points from the book. Book number 3 would be The Buffett Way. This is a really good book. It kind of changed my whole mind about portfolio management. That's really what he writes about in this book, is how they are focused investors. It's Robert Hagstrom wrote the book, and in the very beginning it says, Robert, we just focus on a few outstanding companies. We're focused investors. In other words, he also says you have to be a know-something investor. You should know a lot of everything you can find out about your investment, whereas if you start buying 30, 40, 50 stocks, you can't know everything about 30, 40, or 50, but you can really research about 10. Let's get into talking about the market. Let me tell you where I think we're at this point. I think it's a very important level. Back here in 2000, we had a bubble. It was an investment bubble that got started around 1995, peaked in the first quarter of 2000, and then when the bubble popped, it came down substantially. The real point, though, is that I believe that we've gone through another bubble here that really started building up around 2016. I call it the Tesla bubble because I do think there was a point where everybody wanted to own Tesla. That's what causes bubbles, is the mass public just gets too interested in things. Like here's Cisco Systems. This was starting in 95. You can see what happened. It went from basically $1 a share up to 54, so 54 times, and the bubble popped. You can see it came down, but the most important thing to understand is it took 20 years, 20 years to get back to the level that it was at the peak of the bubble. So the point I'm making is that with investment bubbles, you have to kind of forget about the stocks that built the bubble, because it could take years for them to come back. So here's another example of what recently happened here in 2000. This is ARK Innovation Fund. This is a fund. The biggest position was Tesla. You can see that the fund went up dramatically, up to $155 a share. And if this ain't a bubble, I don't know what is, because it dropped all the way down to right at $30 a share from $155. Now, if you look at Tesla, kind of the same thing. It started building, the bubble built, it got up. We actually exited the stock in this area here, thank goodness, and it came all the way back down to 100, and they just announced earnings last night, in fact, and they weren't very good. So uncertainty ahead. I think that's the key word right now, is the word uncertainty. What's happening here? Okay, connected. Okay, so uncertainty ahead. Look what's happened to mortgage rates. Mortgage rates have gone from 2.5% to 8%. They hit 8% yesterday. So that's about a 300% increase in the cost of owning a mortgaged home. So these higher interest rates are going to continue to be a problem. We should keep an eye on it. Now, we think that the best way to monitor interest rates, because if interest rates peak and then start turning down, I think we're going to have one big bull market in the stock market. The bond market is just getting slaughtered. So here we have it. This is the 5-year Treasury, just hit a new high. This rate of change over the last 125 days says that the yield on the 5-year Treasury has gone up 35.3% in the last 125 trading days, and it's also turning back up again. So until this particular indicator gets back down into this area here, I would continue to stay cautious. So let's take a look at 5 indexes. Now we look at 5. We want to get under the hood here. We really want to look at what is going on with the market. Whereas if you just look at one indicator like the Dow Jones, you're looking at 30 industrial cyclical companies. Whereas these 5 indexes are the NASDAQ, which by the way is 3,000 stocks. You can see the NASDAQ is in a downtrend. It is holding above the 200-day, but it here recently has broken down below the 25 and the 50-day. So NASDAQ is on a downtrend. Mid-cap stocks, same story, below the 200-day, actually getting somewhat of a death cross here with the 25-day crossing below the 200-day, and the 50-day is about to cross below the 200-day. So mid-caps don't look good. New York Stock Exchange, all the stocks on the New York Stock Exchange, downtrend. Then we have the small caps, which are taking the biggest brunt of the damage. Again, you can see downtrend. 25-day breaking down, 50-day is actually broken below the 200-day. It's a pretty strong downtrend. We should continue to be cautious. Now on the S&P 500, same thing. You're in a downtrend there. So you know it's a difficult market, but I can tell you this: there's really nobody out there making money in this market right now, especially people who have bought bonds in the last couple of years. I wanted to point out, though, like with corporate bonds, these are junk bonds. You can see here recently we've had a somewhat of a plummet in the value of junk bonds, which is telling you the market is becoming somewhat concerned about defaults, because these bonds are not like government bonds, they're corporate bonds. So the risk of default is a possibility. So if you have any questions, please let me know. Thank you very much.